All right, so next up we have the BRRRR strategy. So we have buy, renovate, rent, refinance, repeat. So this is really that do-it-yourself strategy where you buy a property that might need some work, but you can actually create value and add that intrinsic value by renovating the deal. Then when you renovate it and get it rent ready, you can rent it out to tenants. Now, after a period of 6, 9, 12 months, maybe more in some cases, the property is going to be considered seasoned by a lender. And that means that the lender will look at the property and say the rental income is stable and we're willing to lend on that property. So at that point, you can refinance the property at that newer, greater value and get more loan proceeds and be able to do this over and over again and repeat the process. So just by talking about it, it's not all that clear exactly how this works from a financial perspective. So let's jump into Excel and walk through an example of what this might look like. All right, so we're back in the SFR Excel resources file and we're on the BRRRR Strategy Simplified tab. And on the BRRRR Strategy Simplified tab, we have 4 deals here. So what we're gonna do is we're gonna start with deal 1 and we'll walk through how all of this is being calculated. So let's start with deal 1. And in deal 1, we assume that we buy a property for $100,000. And we have some closing costs here. So we have closing costs of say $5,000 and our renovation costs are $25,000. So all in, our cost of our project is about $130,000 and our renovated value we'll assume is $200,000. So that's our intrinsic value. We've added a ton of value there. Now, in order to do all this, in order to pay for all of this, really that $130,000 total, we'll assume that we took out an acquisition loan. Now, many of these acquisition loans, when you're looking to do an initial renovation, are going to be based off of a loan to cost ratio. So the loan to cost ratio isn't necessarily just based on your purchase price, but it's going to be based on your purchase price, your closing costs, and your renovation costs. So your total cost of the project. So in this case, we're assuming we get 80% of the total cost of the project in loan proceeds. So that $104,000 is just 80% of that $130,000. So that's that $104,000. And then the equity invested in this deal is $26,000. And again, that's just taking that $130,000 and subtracting our loan proceeds. So that's our equity invested. So we've put $26,000 into the deal, we've renovated the property, and now it's worth $200,000. So then we assume that we rent the property out and we refinance the property. So we refinance the property, we get it appraised, and it's appraised at $200,000. So then the lender tells us that since this is a stabilized property, we have a tenant in the property, we're not going to be doing any sort of renovations. We're going to base this on your loan to value ratio, and that's going to be based off of the total value of your property. So we'll give you 75% of the overall value of your property in loan proceeds. So with that, we'll assume our loan proceeds are $150,000, which is just that 75% times $200,000. So then with those loan proceeds, we can actually pay off our first loan. So our loan proceeds for our first loan were $104,000. Now we may have paid down some of that, but we'll just assume for basic math that we haven't. So we'll assume that we pay off that $104,000 and we pull out cash, we pull out $46,000. So we initially invested $26,000 and we pulled out $46,000. So essentially the cash remaining that we have in the deal is zero. We put in $26,000 and we got back $46,000. So we still own the property. We still own what is hopefully a cash flowing property, but now that initial $26,000 that we had turns into $46,000. So then what you can do is you can go on to another deal. So you still own deal 1, but now you can move on to deal 2. So deal 2, we can afford a $175,000 purchase price because we have $46,000 of equity. So if we do all of this math here, we assume that our closing costs are 5% of our purchase price, similar to what we did for our closing costs on deal 1. The renovation costs are 25% of the purchase price, the same as we did in deal 1. And our renovated value is twice what the purchase price is, again, the same as we did in deal 1. We can assume that if we have a loan to cost ratio of 80%, that our loan proceeds will be $182,000 at a $175,000 purchase price, and our equity invested is going to be $45,500. So that uses that cash flow pulled out. We can again do that same process. Again, once we've rented out the property, seasoned the property, we can refinance this. And now we have our loan proceeds at 75% loan to value of $262,500, and the loan payoff is $182,000 to get our total cash pulled out of $80,500 this time. So now with our equity metrics, again, you can see initial equity invested $45,500 and cash pulled out is $80,500. So now you own two properties and you've turned that initial $26,000 equity investment into $80,000. You still own two deals and you can go out and buy a third. And you can continue to buy bigger properties as you go, assuming these renovations work well and you're continuing to add value. So $80,000 cash pulled out, the equity invested in this case for a $300,000 house with the same metrics is going to give you $78,000 of equity invested, which uses up your cash flow pulled out. You can refinance the property, and this time we're pulling out $138,000 of cash, and then we can move on to deal 4 of $136,000 of equity invested and pulling out $241,000 after the refinance. And with this method, you can continue to do it over and over again. Again, as long as you're consistently adding value, that is the BRRRR strategy. Now, you don't have to keep going. You don't have to continue to reinvest that cash, but many investors decide to do that. It's totally up to you. So now we're ready to move on to the next strategy, which is going to be our debt snowball strategy.